Hi there and welcome back. Finance for Managerial Decision Making, Lecture 3, Financial Institutions. Let's get started. Financial institutions, you'll recall from our previous lectures, are intermediaries, which is a fancy word for the middleman or a go-between between savers and borrowers. There are three aspects of this intermediation process that we want to focus on. One is what we call pooling of funds, or the fancy term in the textbook, denomination matching. And then time alignment is a term I came up with, or maturity matching is kind of the fancy jargon term. And then risk assessment / risk management. So we'll take a closer look at each of these in turn. First off, denomination matching. Households, okay, we're talking about people who put money into the bank, so it could be a family unit, could be an individual, could be a business for that matter, have relatively small amounts of surplus funds. And they put small amounts into savings at a time. So if you think about a typical family or household, they might have a few $1,000s in the bank at any given time. People who need to borrow, businesses, or people buying a home, let's say, are going to need hundreds of thousands, if not millions of dollars. So what a bank will do, and this chart illustrates, is collect funds from many surplus units. That's what these are, the SEUs up here. So there could be thousands or millions of depositors putting in relatively small batches of funds, a few thousand or $10,000 each. And then the deficit economic units over here that are borrowing could be borrowing hundreds of thousands or millions of dollars each. So that's what the financial institution's doing. It's allowing all of these relatively small savers to get payment services with a deposit account, a checking account, debit card, and that kind of thing, and also possibly get a little bit of return on their money. Okay, so we're pooling all these funds and then channeling them through the institutions over to borrowers, people who need them. So that same concept of intermediation from surplus to deficit economic units. Next up, maturity matching. And to understand this role, I'm going to cite an economist I know of who writes very clearly about this, Arnold Kling, an article he wrote for the American Enterprise Institute called What Do Banks Do? And I'm going to actually post a link to this article for your reading. It's short and very useful. It's very insightful about the operation of banks and other kinds of financial institutions. But here's kind of a payoff quote from that article. He says, "The public wants to issue risky long-term liabilities and hold safe short-term assets. Financial intermediaries accommodate this by doing the opposite." So if we think about that with respect to balance sheets for individuals or households that are dealing with financial institutions, and then banks, of course there's other financial institutions we'll talk about, but banks are going to be one of the major ones. And remember what Kling said here, the public wants to issue risky long-term liabilities and hold safe short-term assets. Okay, well that's what's happening here. Individuals, households are going to hold most of their money in the form of deposit accounts, savings and checking accounts. Okay? And that's safe, short-term assets, which are, you can see the color match here, the liabilities of banks. Is when you put your money into a bank checking account or savings account, that's a liability of the bank. The bank owes you that money in the case of a checking account on demand. In the case of certain kinds of saving accounts, there could be a term to that. There could be a maturity date, okay, but they're relatively short-term for both of them. Right? And then he said the public wants to issue long-term risky liabilities, and especially in the case of something like a mortgage loan, which are typically 30-year, that's not especially very risky, but it's very long-term, and so there's some maturity risk with it, some interest rate risk, and so on. And that is precisely the asset of the bank. Okay? So banks intermediate, banks accommodate the ideal financial structure that we want as households or businesses for that matter by taking the opposite side of that. And then of course they make some money. We'll talk about the spread they make, because banks pay a lower amount here for the deposits that they borrow, and then they earn some money over here on the loans that they make. Okay, and then finally the idea of risk management. Individual lenders can't easily evaluate the credit risk of borrowers. So even if I did have a lot of money, even if I had $1 million, I wanted to go invest it, I don't know to whom I should lend it because I don't specialize in sizing up people's credit risk. Well, that's exactly what banks do. Banks, that's all they do is underwrite loans and analyze credit, and so they're really good at determining who will pay off and who won't. Of course, they're going to make some mistakes, but they're also so large and make so many loans that even if 1% of those loans fail, they're still probably going to make enough money on the 99% that pay off in order that they'll make a profit in the end. Two sorts of transactions we can think about here. Households are putting their money into the bank in the form of checking accounts or maybe savings accounts. The banks are then lending that money out to businesses in the form of commercial loans. So that's kind of more of the short-term issue, and here's maybe some longer-term financing. done by some different kinds of financial institutions. Households here are putting money into an insurance company and getting insurance policies in return. Insurance companies have lots of money to invest, and they put it out here and maybe into the equity markets or to the bond markets. Okay, now with that in mind, we can kind of just talk about briefly the different types of institutions and how they operate. Now, we're all familiar with commercial banks. They take in deposits from us, the public, and lend out money to businesses and consumers. So that one's pretty easy. Now, savings and loans are really similar. In fact, they're just kind of a special purpose kind of bank. They take in deposits, a lot of savings accounts, and they engage almost strictly in mortgage lending. And if you've ever seen the movie It's a Wonderful Life, you'll recognize the Bailey Brothers Building and Loan, which was the business that George Bailey, the main character played by Jimmy Stewart, ran, was a classic savings and loan type institution.
No, but you're thinking of this place all wrong, as if I had the money back in a safe. The money's not here. Well, your money's in Joe's house. That's right next to yours. And in the Kennedy house, and Mrs. Maitland's house, and 100 others. You're lending them the money to build, and then they're going to pay it back to you as best they can. Now, what are you going to do, foreclose on them?
I got $242 in here, and $242 isn't going to break anybody.
Okay, Tom. All right. Here you are. You sign this. You get your money in 60 days.
For 60 days?
Well, now, that's what you agreed to when you bought your shares.
Tom, did you get your money?
No.
Well, I did. Old man Putter will pay 50 cents on the dollar for every share you got. Yes, cash.
Well, what do you say?
No, Tom, you have to stick to your original agreement. Now, give us 60 days on this
Okay,
thing.
Randall.
Savings and loans have kind of fallen out of favor in recent years, and by that I mean the past several decades, because by only engaging in mortgage lending, they actually encounter more risk than a commercial bank that mixes its lending across different sectors of deficit economic units. So your big commercial banks, they might make a lot of mortgage loans, but they also make business loans, commercial loans, other kind of consumer loans, credit cards, auto loans, student loans. So it's better for a bank to diversify its risk of its assets, of its loan portfolio across many different sectors. And savings and loans, because they only do mortgages, do face more risk because of that, and they can be more fragile. And there's also some issues with the savings and loan crisis in the 1980s. They had tremendous exposure to interest rate risk, and that really caused a massive wave of bank failures in the S&L industry back then, and that has kind of hastened their demise in terms of popularity with consumers. But they're still out there, and it's important to know how they operate. Okay, next, credit unions. And while savings and loans are kind of going out of style, credit unions are probably becoming a little bit more popular because there's been a little bit of backlash against the big banks and them being bailed out by the Fed or the government, and maybe some unsound practices that they have engaged in. Credit unions are member owned, and they actually pay their profits back to the members, the depositors, in the form of dividends. Otherwise, they function much like commercial banks in that you can put money on deposit. You technically own shares, so it's kind of like savings and loan in that sense. And they make mortgage loans, personal loans, car loans, and they're really kind of growing recently and expanding to take on a lot of the functions that were traditionally just the realm of commercial banks. And commercial banks are increasingly these days seeing credit unions as more of a threat. Okay, so those three kind of institutions form what we call depository institutions. They take in deposit, and then they make various kinds of loans. Depository institutions' business model can be summarized as borrow low, lend high. And it's important to understand this. Banks borrow money from the depositors, and when you put money in the bank, you're technically lending it to the bank. And then they lend to businesses and consumers in the form of things like mortgages, credit loans, car loans, business loans. One kind of humorous way to think about the bank business model is what I've heard called the 3-6-3 rule. And I've heard old bankers refer to this. It's a little bit tongue-in-cheek. The first 3 represents the interest rate you borrow at. So the idea is you pay 3% on deposits and then lend at 6% on different kinds of loans. Let's just maybe say mortgages. And you're earning a 3% interest rate spread, which is also known as interest rate margin. And then the last 3 refers to the banker being on the golf course by 3 p.m., keeping banker's hours. So That's a little bit of a joke, but it's also true. You got to pay less on the deposits than you earn on the loans that you make, and the difference, the spread or the margin between those two rates, represents the income stream of the bank. Of course, there's some expenses to cover, so that's not going to be the net income. After the expenses are paid for, there's some profits left over, hopefully, for the bank. Okay, so as we're getting used to by now, we can think about how a bank operates in terms of the balance sheet. Over here on the asset side, we have reserves, which is cash or cash equivalents. Banks hold most of their money in the form of deposits at the Federal Reserve, the central bank, and we're going to talk about the Fed a little bit here in a few minutes. Of course, they do need to keep a certain amount of cash in the vaults for people who come in needing to make withdrawals. That's going to be a very, very small percent of all the funds that the banks have in their assets, because most of the assets are going to be invested, and the primary line of business is loans. So the bank's going to have a huge portfolio of loans. It's going to probably represent 80 to 90% of its assets. A bank might put a little bit of its funds in some other investments, some short-term securities. And then they've got, of course, some fixed assets, which would be the plant and equipment, the buildings, the furniture, their computers, and that sort of thing. That should be a pretty small percent of their total assets. The bulk of it should be right here in the loan portfolio. And that is the main moneymaker for any bank. The liabilities, the big class of that is going to be the deposits. This is the checking and savings accounts from their deposit customers. And you can kind of think about the deposits as flowing over here to fund the investments, which again is mainly the loans. Banks might go into the bond market or commercial paper market and borrow some funds from time to time. If deposits aren't sufficient, they can go out and borrow some additional funds. They could also borrow funds from the central bank, the Federal Reserve, in a pinch, but banks typically like to borrow funds from other banks or capital markets first. And then, of course, the remainder is known as capital in the banking world. What we call net worth or equity in the banking world is known as the capital. And if you've paid attention much to the financial crisis, which happened about 9 years ago, one of the issues with that was that banks were not holding enough capital. So when there was a decline in the value of the bank's assets, the loans, and it was specifically mortgage loans, declined in value when houses declined in value, there wasn't enough capital over here for troubled banks to absorb those losses. And then there was the risk that banks weren't going to be able to pay back their depositors. And we actually had some bank runs in 2008, just like that little bank run we saw on George Bailey's Building and Loan in It's a Wonderful Life. And if you've seen the movie, you'll remember that George Bailey's Building and Loan got out of their pinch by actually borrowing the honeymoon money that George and Mary had just gotten. And they lent it to their own bank to kind of bail themselves out there in the short run, and that was able to keep the bank afloat. So borrowing, the ability to borrow money from other banks or from the central bank is very important to banks. They're always going to borrow a little bit in normal times, but in a financial crisis they're going to need to borrow a lot, and that's actually the whole reason we even have a central bank to begin with. And we'll flesh out a little bit more here in a minute. Okay, now let's move on. We've talked about deposit institution, banks, credit unions, that kind of thing. Let's talk about other kinds of financial institutions. And first off, we have just what are known as finance companies. And these are just pretty much any entity that makes loans but gets its funds not from deposits but from borrowing money in capital markets. And we just call these finance companies. So you think about an example here would be, think about the street corner payday lender shop. There's also industry-specific organizations that help businesses or consumers finance different kinds of assets. Insurance companies, as we briefly mentioned, are big players in financial markets. Insurance companies earn premiums from the policyholders that they cover, and they have a lot of surplus funds that they need to go and invest. So they're going to put those funds out into bond markets or short-term debt markets. It kind of depends on the insurance company's expectation for when it might need those funds to make payments on claims. And finally, we have pension funds, taking money from people who are saving for retirement. And there's a couple different kinds of plans. Defined benefit plans are the old school type of pensions where you're guaranteed a certain income once you retire. More popular now are defined contribution plans. Most of us who have something like a 401k, that's going to be administered by a pension fund, financial organization, and they're taking in a lot of relatively small contributions. Of course, over time, the individual's portfolios can build up to pretty large values, and they are allowing us, workers who are contributing, to select the investments that we're going to put those funds into. And together, those three constitute non-depository institutions. Okay, so that's the essence of what we might call market financial institutions. Now, there's a few more financial institutions that play a pretty big role that we should talk about briefly. And the big player out there is the Federal Reserve System, which is America's central bank. America went a long time without a central bank, but we also had some financial crises that kind of scared people, especially the big bankers on Wall Street. So in the early part of the 20th century, there was a lot of lobbying for America to get a central bank, and we did in 1913. We got the Federal Reserve System. The main goal of the Federal Reserve was to centralize bank reserves in one place. The Fed still does this essentially. The Fed actually does this and more now, but the Fed initially had pooled the reserves of all the banks in the country in one central location. And the reason for this was that the Federal Reserve banks would then have a large pool of funds to use to lend out to banks in times of financial crisis when liquidity dried up and banks needed funds and people weren't willing to make deposits. And the Fed would step in as a lender of last resort, and that was supposed to forestall future financial crises. Of course, we've had major financial crises since then, in the 1930s with the Great Depression and massive bank failures, in the 1980s with the savings and loan crisis, and then in 2008 with the subprime mortgage crisis. So the Fed actually hasn't eliminated financial crises, but whether the Fed is a net positive or negative on the economy is kind of a debate we don't want to get into right here. Monetary-wise, as of the 1960s, the Fed is the only issuer of United States dollars. And so they control the actual money supply in the country, and we're the world's largest economy, so we're talking about a lot of money there. And as the issuer of our money, they have strong influence on interest rates, because if the Fed speeds up the rate of money growth, they can put downward pressure in the short run on interest rates. That might actually create inflation and put upward pressure on interest rates in the long run. The Federal Reserve is divided into 12 districts, and this was initially so that in the days of rail travel before electronic funds transfer, banks in any part of the country were able to actually physically dispatch someone to the Federal Reserve banks in order to get cash when they needed liquidity. And that's what the Fed is there for, to provide banks with funds. So if you were a bank in Los Angeles, you couldn't afford to send somebody on a train to D.C. That would take several days, but you could go up to San Francisco and probably back to L.A. within a day or so, and you could borrow $1 million if you needed to have funds for your customers if there was some kind of financial pinch. So that was the rationale, and that's why we had 12. Purpose of the Fed, the main thing, as I mentioned, is the lender of last resort. The kind of loans that the Fed makes to banks are referred to as discount loans. The technical term for it now is actually primary credit and secondary credit, but the Fed is basically there to create money and lend it to banks when banks need it, whether it's just a kind of a short-term temporary need for cash, sometimes it's seasonal, or a system-wide financial crisis like we've seen most recently in 2008. The Fed also does check clearing. It helps banks process payments made from one bank to another. And if you saw the movie Catch Me If You Can about the famous fraudster Frank Abagnale Jr., there was actually a little scene in there where they mentioned this.
This is a map of the 12 banks of the U.S. Federal Reserve. Slide. Knicker scanners at every bank read these numbers at the bottom of a check. Slide. And then ship that check off to its corresponding branch.
Carl, for those of us who are unfamiliar with bank fraud, you mind telling us what the hell you're talking about?
The East Coast branches are numbered 01 to 06. The central branch is 07, 08, so on and so forth.
You mean those numbers on the bottom of a check actually mean something?
All of this was in the report I filed 2 days ago. If you change a 02 to a 12, that means that check, which was cashed in New York, does not go to the New York Federal Branch, but it is rerouted all the way to the San Francisco Federal Branch. The bank doesn't even know the check is bounced for 2 weeks, which means our unsub can stay in one place, paper the same city over and over again while this check circle the country.
You know, you want to talk to my wife. She's the one who balances the checkbook at our house.
Next slide.
Of course, that was in the 1960s when payment processing was done manually and through the mail. Of course, nowadays it's all done electronically, but the Fed still participates and runs one of the major clearinghouse networks where banks will clear the payments with each other. Bank supervision, the Fed is one of the main regulators. It determines the reserves that banks need to hold and some regulations of other banking practices. I'll just briefly address the structure of the Fed. It's kind of complex. There's a board of governors, 7 members in Washington, D.C., And then each of the 12 regional banks has its own president. The Federal Open Market Committee, which is the most important body when it comes to determining monetary policy, and that is the Fed's stance towards interest rates, whether it wants interest rates to be rising or falling. And there's a few other things in there, but interest rates would be the main tool of that, is determined by the 7 governors plus 5 of the 12 district Federal Reserve presidents, with the exception that the New York Fed president is always on the Open Market Committee. And there's a little Wall Street favoritism going on right there. That is located in Washington, D.C. They meet, I believe, 8 times per year to determine what they want to do with interest rates and monetary policy, and really trying to guide and manage the entire economy, the macroeconomy, through the tools of monetary policy. And then the 12 banks, as we mentioned, and then member banks. All of your nationally chartered banks, the banks chartered by the United States government, are going to be Fed members. Most of your state chartered banks are also going to be Fed members these days. Now, as I mentioned, monetary policy, the Fed is interested in changing interest rates to try to manipulate or stimulate overall economic activity. And there's a few ways they do this. The main way is buying and selling federal securities, T-bills or treasury bonds, through a tool called open market operations. The Fed can buy government bonds. You might ask, where does the Fed get the money it uses? It creates it. The Fed has total control over the money supply. The Fed can create as much money as it wants to when it wants to, and it typically will use that newly created money to buy treasury bonds. When the Fed buys treasury bonds, that makes the money supply go up, and through something known as the liquidity channel, that's going to temporarily put downward pressure on interest rates. Now, if the Fed tries to do this too much, I want to just note here, we're not going to get into the nuts and bolts of monetary policy operations, but if the Fed tries to push interest rates down too much, it might actually wind up creating too much money, which would create inflation, and then through the operation of the Fisher effect, would actually push interest rates up in the long run. So there's some kind of arguments in the economic realm about how much control the Fed actually has. The Fed definitely has some influence over interest rates in the short run, but in the long run, interest rates are market phenomena, and if the Fed tries to meddle and manipulate things too much, it could actually kind of backfire and actually make economic conditions worse. There's a few other tools. The discount rate is the rate the Fed charges to member banks. Now, this it can control directly, and it'll typically, if it wants to raise market interest rates, it will go ahead and raise its discount rate accordingly. Reserve requirements is a tool that's not really messed with much anymore, but the Fed does determine the amount of money banks need to hold on reserve against their deposits, and this is going to be anywhere from the 0 to 10% range. As we mentioned when we talked about the bank balance sheet, most of the money banks get from deposits is going to go and be lent out so it can earn money for the bank, and only a slim buffer amount of funds is going to be kept in the vaults to meet the demands of depositors who might need to withdraw cash on any given day. Okay, now we'll wrap up by just noting a few other financial institutions that are pretty big players, and these are the government-sponsored enterprises: Fannie, Freddie, and there's a few others here, Ginnie Mae, Sallie Mae, which is now known as Navient. Fannie and Freddie are secondary investors in mortgages. That means when banks or other financial entities go and make mortgage loans, Fannie and Freddie will go in and buy up a lot of those. Fannie and Freddie will hold them and issue bonds against them, or they'll bundle them into mortgage-backed securities. And mortgage-backed securities are just really bonds that derive their payment stream from mortgages. I don't want to spend time going into this. You can read about it certainly in the textbook and on your own. But Fannie and Freddie were significant players in the mortgage crisis in the mid-2000s and the ensuing financial crisis in 2008, 2009. They were bailed out, went into government ownership actually. And so you want to be aware of who they are and what they do, and they have a very large presence in American financial markets. Okay, so that wraps it with our quick overview of financial institutions, and that actually does it for Unit 1. When we come back in Lecture 4, we'll be diving into businesses' financial statements and how we can look at those and assess them to determine a business's financial health. See you soon.